Hey everybody, Ashley Page here. Thank you so much for joining us on our educational vlog today. Merry Christmas to all of you. We hope that you have a wonderful week with family and friends. For those of you all who are new to the educational vlog and our content in that, what we try to do every Thursday is to go a little bit deeper on one topic to help your understanding with money and markets. That's as opposed to the guys doing the portfolio vlog on Monday, which sort of tells you what's going on in the markets for that week, and some of the other research content that we send you on Tuesday. So what we always do on the educational vlog is try to take one topic to give you a little bit better understanding about it, because it helps particularly our clients know a little bit more, pulling the curtain back how we work, and that's what we'd like you to have. So our topic today, preferred stocks. What are the pros and cons? You know, when you usually are talking anecdotally, and we say stocks and bonds, just in general conversation, what you're really thinking about are bonds and common stocks. Well, we wanted to highlight what is sort of in between those two and somewhat of a hybrid known as preferred stocks. Preferred stocks have features of both bonds and stocks and sort of operate in that middle ground. And we often call them stocks that act like a bond. So if you look at preferred stocks legally, you do have ownership rights in the company that you're investing in. So it does give you that, much like common stocks also do. However, the way that preferred stocks pay investors is much more like a bond. You have call dates on that, issue date, you have maturity dates on that. Usually when they're issued, like 5 years is a good sort of common term with that. And so when you look at that, the best way to look and to refer to preferred stocks is sort of a hybrid. They're a little bit like bonds and a little bit like stocks. Again, they are stocks that act like bonds in the way that they pay. So the main advantage that you have in owning preferred stock is their dividend yields that they pay out are generally higher than common stocks. So that's the main thing. They pay a little bit more. Secondly, their dividends have a tendency, not always, but to be a little bit more regular with the company paying those out. To give you a little nuance there, though, you can have what's called a cumulative preferred stock or non-cumulative. What's the difference there? A cumulative preferred stock, a company can miss a preferred stock dividend on cumulative, but as the word suggests, they have to go back at some point and make that up. They owe you that. A non-cumulative, they can miss from time to time. But second big advantage is that the dividends have a tendency to have more regularity to them. Also, too, because they do behave somewhat like a bond, preferred stocks have a low risk of capital loss. We'll see in a minute, you don't participate so much in the residual profit pickup with preferreds, but they're a little bit safer in that way because you're taking a little bit lower capital risk vis-a-vis common stock, that they have a little bit less risk on that. And the other thing that you have, again, they operate very much like a bond in the way that they move. When interest rates fall, their face value on preferred stocks can gain. So it's an inverse relationship like bonds are. You come up with the term preferred stocks because in the hierarchy, when a company is raising money to fund their operations, that's what we call a company's capital structure. First, what they'll do is they'll go out and borrow from a bank, that's up top. And then down below that a little bit, they'll issue bonds to investors. Then the next class down is preferred stock. And then the next class down, what most people are familiar with, is common stock. So thus the name preferred stock comes from, in ways in terms of the legal hierarchy, they are preferred over common stocks. So we just went through the 4 advantages of having those. Again, mainly it's the fact that they have higher yields. Now, what is the primary disadvantages of preferred stocks? The main thing is, as opposed to your common stock, they don't have voting rights. So that's the one thing you can't participate in. You don't have a voice in how the company is run. So you don't have voting rights in preferred stock. Again, more like a bond feature. Secondly, as we were talking about a while ago, the reverse is true. Preferred stocks have low ability to have capital gains in the residual profit. So where many times a common stock, where a company kind of really takes off and does well, you get a solid dividend production, but you get good appreciation in shares. You don't have as much of that feature in preferred stock. Also, too, as we said, they're still below bonds. So preferred stock dividends will not be issued by a company until the bondholders are satisfied. So you're still in the order of payment, you're still below bonds. And then finally, the thing that you have to watch a little bit is that preferred stocks will lose their value when interest rates rise. Of course, that's the climate that we're in right now. So I was asking our Chief Investment Officer, Trey Booth, this morning, in terms of our history in holding these. We do preferred stocks, of course, for clients, but the main way that we buy those are usually through mutual funds or ETFs, exchange traded funds. And what Trey was saying is it gives you the advantage, of course, of being more diverse in preferred stock holdings, but also it allows you to go in and get fractional shares. So obviously, you're not going to hold nearly as many when you have a rising interest rate environment, but they can be a very good tool in a portfolio when interest rates are dropping because you get some gain in the value, but you also get a dividend yield that on average is a good bit higher than common stock. For the most part, we're asked from time to time really kind of who owns preferred stocks. Of course, we have that here with individual investors, and they certainly do. But pound for pound, you see most preferred stocks being owned by institutions as opposed to individuals. Of course, individuals can. And again, we do that through the mutual funds and ETFs here. But basically, if you break it down, you see more institutions doing that. A lot of times we're asked too, what kind of companies will issue preferred stock a lot for people to invest in? They have a tendency to be companies like banks, insurance companies, utilities is another good example of that. REITs do that, real estate investment trust. And one reason that a company will use preferred stock is that they want to go into the capital structure and raise equity. But because they don't give up voting rights, many companies will issue those that are concerned maybe later about a hostile takeover because they are putting an equity fundraising tool out there. But again, you don't have voting rights in it, so that's a good way for them to avoid that. So we hope this helps you understand preferred stocks and their advantages and disadvantages a little bit more. As always, we love to hear from you. You can reach out to us on any social media platform. You know, we're Southerners too, and at Christmas particularly, we love when our clients and friends just come by to see us. Also, feel free to call us on this topic or any other on the investment side, either myself or the guys on the portfolio team. Always glad to hear from you. So once again, Merry Christmas. Hope you have a great holiday. We'll see you soon.